Hey guys, welcome to the fifth episode of Finance Operators. Today we're going to cover a lot. Obviously, we're going to jump into tariffs, what you should be doing, how most of our friends are reacting, what's going on. Then we're going to jump into a little bit of M&A, like Lesser Evil, as well as Road, which is Haley Bieber's company. And then we're going to talk a little bit about the current climate for raising growth equity, just minority equity in general, if you're trying to look at VC. And we'll top it off with what we're working on personally. So we're going to jewelry roll up, and we'll discuss that, the mechanics for it, as well as some liquidity options if you're looking at selling your brand and kind of what that looks like. I'd like to thank our sponsors. We have Fulfil, Fondue, Numeral, and obviously, I don't want any of you to forget about the Operators Pact. So if you're listening to this, you are obligated to go to YouTube, type in Finance Operators, and smash that subscribe button. Let's jump into it.
Let's start with tariffs. I think we don't need to beat a dead horse around what's going on exactly. I don't even know that anybody knows what's going on, but I do think
well, there was another 50% tariff announced today on China that'll go into effect tomorrow, which is great.
Well, that is worth calling out probably. But besides that, I want to start to move away from this, what's going on conversation around tariffs, and I want to move towards the tactical sort of ways to combat it, because I think we can sit here and sort of complain and whine and cry all day about it, but at the end of the day, it's the reality of the situation is what's going on. And so I think about the tariffs and I don't think they're really that special. I mean, it's really obviously pretty tough right now, but there's always something, there was iOS, there was COVID, which turned into a good thing at some point. There's tariffs. It's just the reality of business is there are these sort of macro headwinds that pop up once or twice a year kind of a thing. So what I want to get is a little bit more of a conversation going around what's the right way to react. I've seen some things on Twitter that I really don't agree with, people that are trying to say hey, this is the the antidote to the tariffs. And so I want to have a little bit of a guided conversation sort of around what is the best thing to, and we talked about it a little bit in one of our other episodes, but maybe just taking a step back from a financial perspective and evaluating your business. What's your sort of overarching take on the most effective way to deal with these changes?
Yeah, I think internally we're looking at it as a permanent hit to margin, just assuming that they're going to be sticky to some extent. Will they be 124% for China? I don't know. I think maybe those settle a little bit higher, around 30%. And then maybe tariffs elsewhere kind of settle closer to 10%, I think is what we're hoping for. But I feel like the biggest thing is ensuring you actually know where you sit right now and what your unit economics look like, right? In turnaround work, we have a phrase for either your balance sheet turnaround or your income statement turnaround, or you're both. And I can explain that. So by income statement turnaround, I mean your unit economics are fundamentally broken. You're losing money on every sale, so your CAC's outrageous, or your COGS are horrible, and that's a really bad place to be. You need to understand if you're still profitable, if you're not, what's happening to your cash flow cycle, et cetera. And then conversely, if the balance sheet turnaround or balance sheet hiccups, and that's just you're building up too much debt, you get one-time CapEx or something really big or chunky that's sitting there. The good news is if you have one or the other to deal with, usually it's not too bad. Both at once can be really, really bad though, and really difficult to deal with. We don't like to do both at once anymore. We used to when we were younger, but I'm too old for that now. So
which one would you rather see? Balance sheet?
Yeah, balance sheet for sure. Because I feel like most of the time it's pretty easy to come in, negotiate with lenders, be like, hey, look, there's a good business here. It's cash flowing. We can get it up to 15, 20% net. We'll have you guys paid off in 12 to 15 months. Yeah, it sucks. Sucks for them too. They're taking austerity measures. They've cut some of the team. They aren't paying themselves as much, and kind of get your way out of it, kind of work your way through it, right? But when the unit economics are fundamentally broken, then it starts to become terrifying. It's all right, well, why are we losing money? Is there a good reason for it? Is there not a good reason for it? Is it a product in this case that can only be manufactured in China? In that case, you're in some serious trouble. So I would start there. Really understand have a good snapshot of your unit economics. Is there any way you like to build it out? I can tell you how we build it out, and then you can go, or you can start.
Well, I want to boil down what you said, right? The unit economics. So if you're saying let's start at the unit economics, that is I agree, because the unit economics live in between the revenue line and effectively the contribution margin line, right? And so you're talking about basically above OpEx in the income statement,
Yep.
which I agree with. I've seen a handful of people that have come on Twitter basically saying that like operating expenses are like where you should cut costs. Like Taylor said it and Jay Dolwani said it. A
But they're
few
just
a few
not that
people.
big. They're just not that big relative to COGS or even CAC, right? Like if you're looking at a D2C brand, 20 to 40%, even 50%. I mean, you have a better idea than I do, but 20 to 50% of your revenue is going towards customer acquisition. And then, anywhere from, it depends on the brand, obviously, like 10 to 40% is going to COGS. And that's just a huge chunk, right? And you change that, say 40% by 10%, it's just way more bottom line translation than anything you're going to do on the OpEx side.
I totally agree. I mean, I'm not like against like the idea of like auditing your OpEx, and like candidly, like I have a very vested interest in people like looking to compress pricing in their operating expenses.
Mhm.
Like that's the whole point of Iris, right? Is that, like you're overpaying for your data stack or FP&A service, and so as much as I would like to turn this into a tailwind for us, from that perspective, like I honestly think that our customers should be focusing elsewhere. Like I think the sort of the idea of like a net revenue number as far as like discounts, like discounting is like a really important one that you can probably pull. Um, and then just basically like downsizing revenue and like reducing CAC. Like I think reduce your CAC is really really terrible advice all the time. But in this
It's
standpoint,
just
like
hard to
people.
do and it's unpredictable, right?
Yeah.
Like you don't
Yeah, it's
really.
like if I could do it, I would have done it already, like that kind of a thing. So I think,
There are some costs you can cut. Like, for example, if you're still using one of the legacy players for sales tax collection, you can switch to something like our sponsor, Numeral. And I like Numeral because we were squeezed specifically by one of the legacy players in sales tax collection. I won't name them. I'm too nice, but they changed prices on us a few times. And I mean, an increase of like, I think it was 1.5 to 2x what we were paying. And they just knew they could do it because they were the only game in town. Now they're not. Now there's cool new startups like Numeral. I guess Numeral's not really a startup anymore. They just raised a huge chunk of money. I think 18 million in their Series A or something crazy. So uh, they have really good software. They're backing it up with guarantees. They literally have a guarantee where if they mess something up, they'll cover up the cost. They'll cover the cost of their mistake, which is just an insanely awesome guarantee. I've never seen anyone else offer that. An accounting firm will never offer you that. Uh, they'll laugh at you if you ask about that. It's used by Imi, Graza, Muddy Bites, and even Mike's Hot Honey. So the people love it. We've had really good experiences with it. We use it at one or two portfolio brands, I think. And yeah, I check it out. It's a really easy implementation. So save some money. Again, that's Numeral. All right.
um so so yeah, I mean like there's definitely like oftentimes like operating expenses like to be saved on. Like I'm not, sort of disputing that. But I do think, when you just look at the income statement and like you said, the unit economics, like, let's say you're doing like $10 million in revenue, and like even if you did have like a 20% OpEx, which like is very very high by any stretch. I don't know like
Uh-huh.
where people are coming up with some of these numbers. Like the Iris benchmark, for example, like almost
Is it
almost
like
all of our
8%?
almost all of our customers are in between 7 and 13%. The
Cool.
average is like
Yeah.
right around 10 or 11.
That that line's
Um,
literally right up with like the deal flow that we see typically anywhere from like right in that range. Yeah.
Yeah, people were trying to say it's like usually closer to 20. It's like a very well accepted benchmark that OpEx is like, 8 to 12% kind of a thing. Like I'm not going to argue that it's silly. But essentially, I think what some of these people might be looking at are just like smaller brands, right? Like if you have a
Totally.
brand that does $1 million in sales and you pay yourself 100 grand, that's your 10% right there already. And
Yep.
so obviously, like when you have lower revenue, like expenses are just a higher percentage of revenue in general. And so, um, yeah, like I want to talk a little bit about sort of like OpEx as like the foundation of the business in a lot of ways, right? Like I think it's actually a mistake oftentimes to go and like immediately start trying to reduce OpEx unless you're going to have like a subsequent revenue decrease, right?
Right.
Because you're not investing in like the infrastructure of the business to actually support your revenue level. Like if you have, let's say, $50 million in revenue and 10% OpEx, then you cut it to 3%. Like it's just not going to be sustainable. Like you don't actually want like OpEx like as low as fundamentally possible. Or do you agree with that or not?
I feel like we just kind of whenever we look at a brand, we try to come in and rationalize things. I think if you're dealing with a limited, let's say you have a limited amount of time, just making up numbers here. Let's say I have 50 hours and I can allocate 50 hours towards cost cutting or something like that, or improving margins. I want to focus on whatever the big needle movers are. So I want to focus on whatever the biggest percentage of revenue is. And like you said, it's rarely OpEx unless it's totally out of control. So I'm not saying I wouldn't do it. I'm just saying I would prioritize other things first. And then I would come back to that and come back to the people and rationalizing the people. And often the people are the ones that are causing issues with the unit economics being broken, right? Like if you have a supply chain guy who doesn't visit factories, doesn't really do much on the sourcing side, it's a little bit concerning. And that's where a lot of the problems can stem from. So that's the way we look at it, if that makes sense. But like I agree with you, you should go wherever the 80-20 is where you should be focused.
Yeah. And do you think there's what do you think is like the case to be made for like we're just like shrinking your business? Like do you think that we're there yet and people should start to like, if you're going to see that kind of a gross margin hit, like I don't know if I am here all the way yet, but I actually do think it could be a pretty effective tactic, is like literally just cut your revenue by 25% and like see how much your CAC goes down and see if the contribution margin ratio doesn't actually expand out of that. Do you think
I think
that's
it's dramatic?
dramatic?
Whenever we've seen a company downsize, sometimes CAC hasn't really moved. It's actually become worse. And it depends on the channel distribution too, right? Like if you're selling through a lot of, let's say I'm a pure play D2C brand, that's fine. Maybe you can make something work, but it gets so complicated when you have retail channels, right? And different types of retailers that you're selling into, they might be more profitable, less profitable. Let's say big box is just way more pain in the ass, way less profitable than like small businesses that you're selling to who can be very, very disgustingly profitable. So it just depends, I think, on the composition of your revenue and then what you're selling as well. Because sometimes you won't see as much of a decrease as you would have hoped. Like we had a brand in 2024 where revenue went down 20% and CAC went up 20%.
Oh, seriously?
Yeah, we have no idea why. And this year's been really good. Like this year's just ripping. So I don't know what happened there. We don't have a great answer. I think we'll know in like a year or something. Maybe we'll look back and figure something out.
That's crazy.
Yeah. So I mean, we've looked at so many companies too, where we've seen revenue decline, say 50%, but CAC just stayed the same. And it's because they were in something with a really large TAM where they weren't really hitting the roof, right? Maybe if you're doing 300 million a year, it's more of a concern. But if you're doing like 30 to 50 million a year, you're selling apparel, I don't think you're really close to maxing out your TAM. Unless you sell something really niche. So
yeah. I think the other thing I wanted to get your advice on is like what's the right way for operators to kind of think about like what direction they should go, right? Like I think it's really really hard to know right now like what's actually going to happen, and so I think we've covered the tariffs from the idea of like what's happening. We've talked a little bit about how to kind of combat them,
right.
but then like as we like turn our heads towards the future, at the end of the day like nobody actually knows what's going to happen, right?
No.
And so how are you guys from like a budgeting and forecasting perspective? Like how are you behaving right now, and has that changed at all?
We're just trying to be we're looking at everything fairly pessimistically and building downside cases for kind of 30% down in revenue, 30% increase in CAC, which is pretty extreme.
Yeah.
But we want to be able to toggle and survive something like that at all of our portfolio brands. At the same time, we're holding off any sort of big expenditure. So if we had a project plan that would have been like, I don't know, $500,000 or $1 million in outlay, we'll just pause that until we kind of get more clarity on what's happening with the tariff side. Same with hiring. Yeah, so that's why we're looking at it for now, just given we don't have any real.
And what do you
clarity.
think? How long do you think this is going to go? Like this, like sort of holding pattern is going to go on for? Do you have any sense for how long you're going to pause those projects for?
I think at least 30, 60 days. What do you think?
I was going to say a quarter, just because I think July, like, I don't know, maybe like August maybe is when people will kind of come back and start to maybe think about, what exactly to do. But yeah, I mean, I think it's just hard to know. It's hard to know. And
I think
I want to
like the thing we're less worried about. I'm not necessarily worried about the COGS increase. I feel like you can do a lot to offset that. Maybe you find a way through it, whatever, right? The bigger concern is 60% of the products in Walmart are made in China. And when those tariffs hit, I'd assume Walmart starts to raise their prices. And obviously that kind of goes, there's a good example of a big retailer that a lot of people shop at. I mean, the common consumer is going to be so weak, right? If they see everything they're buying just suddenly become far more expensive. I don't know if they're looking to buy uh, non-essentials at the same rate they were previously. And I have a few friends who run beauty brands, and it seems like they're really feeling it right now. They
Oh,
said they
really?
started feeling it like late last week, which I was surprised by. And maybe it's just a, I don't know, meta hiccup or something, but they're decent scale. And I'm kind of surprised they said they're feeling a slowdown already. Drew, did you ever get that tattoo, by the way?
Which tattoo?
The Welcome 10 tattoo?
No, I didn't. Was I supposed to?
Wow. No, you shouldn't, because Fondue is one of our sponsors. They do something amazing. They juice your margins. Cashback feels like a deal, converts like a coupon, supercharges those margins. Fondue lets you offer cash back to customers instead of straight discounts. No more Welcome 10. Cut it out. The result, you'll retain more margin. You can advertise more aggressive discounts. In my opinion, it's cheap, fast, and low risk test to run, especially right now. Everyone needs every point of margin they can get. Throw it in your promotion cycle. See what happens. Ping us afterwards. Let them know that the operator sent you.
Yeah, on our last episode, we talked a little bit about how we thought that beauty might be insulated. So I wonder
Mhm.
if it's directly correlated to the tariffs, or if there's something else going on. But I also did I pulled like a really sort of robust data pull from Iris right before the tariffs hit. So we can do a little bit of like a before and after maybe in like a couple of weeks, where I've got like the AOVs, the gross margins, the sort of year over year revenue growth, like all of that good stuff. And so I might just pull it like once a week just to kind of like see the trajectories
And then
and
we
where
could
things
dive
are
in.
trending. Yeah, but I think it's too early to like probably start looking at that stuff right now and being like, what's happening. Like I've seen some people that are like talking about, oh, like AOVs are up this much already, and it's kind of like, well,
Yeah, it's been like a week. Yeah, it hasn't
it's
been
been
very
like
long.
4 days.
So,
Yeah, like
yeah.
I mean, I'm sure people are already sort of in action trying to get ahead of it, but it's gonna take like just like a little bit longer than that probably. Um,
So if I'm
so
if I'm a D2C brand and I don't have my stuff buttoned up per se, let's say I'm doing like 10 to 30 million ish, what what would you do first as far as reporting package to figure out what to do, what to look at? What do you want to be able to see visibility into?
so the number one thing that we end up sort of helping people with is just like benchmarking their costs. Mostly like gross margin costs. So like 3PL is kind of the big one.
Mhm.
So like I think there's a huge, and oftentimes people just like don't renegotiate their rates even when they're growing and it's been 2 years or whatever. Um, so like if I'm a brand doing in between 10 and 30 million dollars in sales, and I'm thinking about how to deal with all this, um, honestly, like this, this hurts me a little bit to say because I don't know that I'm a huge fan of it in general, but just like price testing, like just like A/B testing and like trying to understand like how far up you can push your AOV. And like honestly, like if you have like a decent, bundle or price test or whatever, like you can pretty much get beyond the tariff impact or at least largely out of it, just like with one good sort of move on that front. And then other than that, like you have to go line by line and find out sort of like where there's opportunity for saving. So like 3PL is like always a huge one. I couldn't even tell you the number of brands that come to us and like they're spending 25% of their revenue on 3PL. And I'm just like, this is
Wow.
crazy. Like, but they don't even know. And so I think like it's really important context for operators. And like, I think back to my Mad Rabbit days where I'm like, all I ever saw was that P&L. Like I didn't know anything else that was ever going on anywhere else. And then now that I sit in the Iris seat, um, I think it's way easier to sort of very quickly spot like who's
Right.
who's sort of getting ripped off and who's not.
Yeah, and we have
um,
access to we see the same thing, right? Like where I can see what you're paying for fulfillment and I know if it's weird or not compared to what we're used to.
exactly.
Like we were just working with a brand over the weekend on they just got slammed by tariffs. So we're just helping them with expanding their margins again. And there's a lot of that going on where the 3PL was kind of railing them. A lot of things the 3PL were doing didn't really make sense, etc. So yeah, it's hard if you don't have full context.
And like sometimes like really fast growing brands end up paying their like ad agencies like 50-60 grand a month
Mhm.
because it was like supposed to be like 10% or 15% or 20 whatever percentage of spend. And like I'll see it right away when I like do a deep dive with somebody, and I'm just like, you literally paid $60,000 last month for Facebook ads. Like that's the craziest and like they're not that big. And it's just like you just literally tell your agency that number is now in half, and like 100% of the time they will say okay, no problem.
Yeah, I think they totally get it. Okay, that makes sense. Anything else you want to talk about on this side of things?
No. I mean, I think, just to sum it up, like, it's painful. Nobody really knows what's going to happen. The best thing that you can do is really dive into your P&L and just make sure that you're not overspending anywhere. Do a couple price tests, figure out how you can get AOV up, how you can get pricing up in general. I think this is going to be inflationary. Like, prices are going to go up across the board. And ultimately at the end of the day, like, this is just it's just part of the game. I mean, we see these types of hiccups and headwinds all the time, and hopefully this. I can't imagine that this tariff thing is going to last very, very long.
Hopefully.
But yeah, hopefully not.
And then, okay, that makes sense. Do you want to go into M&A?
Yeah, I want to talk about a couple things. So we saw Lesser Evil, the popcorn brand. They're going to be bought by Hershey's if all goes well for $750 million. So I think we are continuing to see momentum and sort of like the large cap CPG M&A.
And Hershey's
which
was Hershey's the one that bought Sour Strips as well?
Yeah, so this is I want to
Okay.
talk about a few things with this, but like they bought Sour Strips for 75.5 million in November 6th of 24 or something, and now they're buying Lesser Evil for 750 million. And so I thought that was like pretty crazy range from like an acquirer. That Sour Strips deal
That's
is
very small
odd
for their size.
It's very, very odd to me. It was actually in all of their SEC filings, like they basically didn't have to disclose anything because it was like less than 1% of like any number on the Hershey's, balance sheet or whatever. And so I want you to guess maybe or sort of opine on why they did that. And then how can they have this level of range? And then we can talk a little bit about Lesser Evil too.
Yeah, honestly, I'm not too clued in on the F&B side, like I said before, but I suspect it's just because it's a very different model than what they were used to, and they might be interested in getting exposure to it. It was influencer driven. I don't know what their arrangement is post acquisition. The founder was like an influencer, and then he started the brand, scaled it to a great size, etc. Great outcome. But like you said, it's a little bit odd because it's kind of small for Hershey's, but maybe they feel it's something they could really plug and play into. They might like that it kind of feels quite different than anything else they own. I think that's probably it, and trying to get upside to that.
Some people have kind of said it's like, obviously cocoa prices have been like going berserk. And so there's just like a general desire to like diversify away from that. Which maybe, but I think it's interesting that you bring up sort of the influencer driven part. So like I feel like a lot of those brands have been doing extraordinarily well. Like Poppy was like pretty influencer driven. Alani Nu was definitely influencer driven. Sour Strips influencer driven.
Who did Alani really work with? Was that Kim Kardashian?
No, they're the founders. The two founders were like fitness influencers. Yeah,
I didn't know that. Okay. Oh.
Yeah. So, it's something that I'm opening my eyes towards a little bit. Is just like these sort of influencer led brands are really seeming to do well, which is kind of interesting because I think there's a lot of shade kind of around like the prime, the primes of the world where it's like they're absolutely capitulating on sales, but
totally.
Either way, so one thing that I thought was interesting too was like Lesser Evil. The sort of leak came out. I don't know, 2 or 3 months ago. And in the leak was Lesser Evil explores sale for $1 billion. And then Rhode is Hailey Bieber's like skincare cosmetics. Yeah. So they said the same thing that Lesser Evil said like 2 months ago. They said, hey, like Rhode is exploring this sale for $1 billion, which I don't think there's any way. But essentially, there's always this pattern, and I want you to tell me why, because it might just be price anchoring, but like, why do they always go out and they say like, we're going to sell for $1 billion, and then 0 out of 10 times it's like that's the actual number that they end up closing on? Like, it's still 750 million, like it's still a huge deal, but like it's 25%, different than what they kind of said they would get. So I'm a little curious if you have any insights on that.
I think it's one of those things that's just kind of arbitrary that a founder or a team wants to be able to say they did, right? Like, it sounds a lot cooler to say you sold something for $1 billion as opposed to 900 million. I think, honest to God, I think that's what it is. I've seen a lot of stuff retrade last minute or have weird concessions in it so that a higher valuation could be marketed. You see it a lot with like venture capital, right? Where someone will want
Yeah.
to be able to say they raised at an X dollar valuation, and in exchange they'll give up some crazy liquidity pref or something. Have you seen that before?
Yeah, it's insane, and I don't know why founders do this. I mean, you either are like ego driven or just extremely, extremely confident. Um, and I don't even know if like being extremely confident is like you're arrogant almost, right? Like it's not even like you're confident. It's like you, but sometimes it works out for people. More often than not, it doesn't. Um, but yeah, like I was running the numbers on Road, and you know they go out and they say that they want $1 billion, and I mean the company's three years old. And I don't see like the best comp is Summer Fridays. Do you know Summer Fridays?
Right.
So
No, I'm not familiar. Walk me through it.
Summer Fridays, it's basically the same exact thing. It's like mostly like lip care. And so like they just got sold from Prelude Growth to another large private equity fund, and the rumors were like they were in the sort of 200 million plus range. They had omni-channel distribution. The company's about 10 years old, so pretty much by like every measure, like Summer Fridays would be a more valuable transaction. But it was sold for I don't know exactly if these numbers are public, but it was sold for around 750 million from Prelude to TSG. And so I have a really hard time sort of seeing Road kind of go for more than that, especially because of the key man risk around Haley Bieber, and like if she
Yeah,
steps
it's
away.
terrifying, right? I mean, I think the influencers thing's cool for getting exceptionally low CAC for a while, but it is still terrifying. You never know when they could go full on Kanye and just randomly turn into a crazy racist or something.
Have you guys ever done like an influencer brand?
My first two were actually really influencer driven. One was Blumaan, which is still around. So if you type in BLUMAAN.com, that one was done with like a men's hair product company that was influencer driven.
Cool.
He's a good guy to work with. And then the other one was Horizon Devices, which is also still around. So if you just type in horizondevices.com, that's like a very niche product. It's a, how do I describe it for normies? It's a distortion pedal for guitars. So you can step on it and it makes your guitar tone sound different. And I used to play a lot of guitar, so that's why I got into it. And I'm really good friends. The co-founder, he actually started a band called Periphery that's weirdly big, and it kind of invented like a niche subgenre of metal. And him and I had traded guitars a bunch with each other before. And then his first pick for the CEO died in a freak accident, and then I was the second pick. So
oh Jesus.
yeah, like the guy was driving on a highway in Portland, and he wasn't intoxicated, and just totally normal, totally sober, just driving normally. And a tree fell on him and killed him.
Oh my God.
And then I was the second pick, and it turned out really well. So sometimes you get lucky, sometimes you get unlucky, I guess.
Did they have Keyman insurance?
I don't know. I think the existing company he had before, I think he ran into a bunch of issues because it was relatively small. But yeah, totally unfortunate. I'd actually talked to the guy a bunch too, because I knew him. He was fairly big in the industry. So bad luck. There's my influencer. There's my experience with influencers.
Yeah, I mean, I think. So let me ask you a question. Like, if you were going to start, let's just say you were going to start like a brand, sort of like from scratch today.
Yeah.
Do you think it's worth like partnering with like a sort of influencer to be the face of that brand, or how would you think about that?
I probably wouldn't do it. Like, we still look at a lot of influencer driven deals. I don't really like it per se. I actually think a lot of them end up in weird situations because they end up in a specific niche, or they can't really scale their team into doing something. Actually, I was just thinking about this. Our the men's ring company that we have equity in, Patrick Air Designs, that's technically an influencer who started it, but he did a really good job of separating himself from the brand and just staying focused on the product side, if that makes sense. So I think it'd be kind of hard if they don't do a good job of that, but it's possible to do it. If I was launching something new, I probably wouldn't do it. The catalyst for doing it initially was just I had no money and I was a kid, so it made more sense. But now that I can write a check to kind of fund things, I don't think it's as big a concern. So I wouldn't do it in 2025. I think it's a lot of risk, a lot of upside gone. Really?
I would do it. I would actually only do it with an influencer. If I was going to start a new brand today, yeah, I wouldn't.
That's funny.
I mean, unless it was going to be like a really, really large TAM product. Like I think the benefit of being able to get off the ground with like lower CACs is probably worth it for me. I'm also
Yeah.
not I'm also not much of a marketer, honestly. So I would probably need somebody who's a little bit more creative on that side. And honestly, like if you suit some of those influencers up with like the right team and equipment, like they can be huge content powerhouses. And like what I would do is I would go to TikTok and I would partner with an influencer and I would list on Amazon, and that's how I would drive most of my sales, probably. Just based off
That's
what I see
funny.
in some of these Irish customers, like some of these guys
Yeah.
really cook with like that sort of a setup.
Yeah. My only issue is your a D2C brand can only get so big so quickly, and you lose so much of the cap table often. And it obviously depends on the operator that's setting them up to start the business, right? If you're someone with a lot of
Mhm.
experience and you're writing a fairly large check, it's a different conversation than if you're a 22-year-old with no money. So if someone's coming in and the influencer's taking like 20 to 60% of the cap table, I don't like that because I think it's too hard to get to a decent scale where you can where you can have like a good outcome and a good exit. I think, yeah, it's just bigger concern for where I'm at, I
Yeah,
guess.
I mean, ultimately, that's what it comes down to is just like, what are you gonna have to pay them? And they oftentimes have
Mhm.
like pretty inflated senses of worth. But I mean, I've seen some of these influencer brands with like MERs like in the 10 to 20x, and it's like and they can get definitely off the ground, and like they're
Hey,
usually pretty
we were
profitable. And
we were total morons at both of those brands I mentioned because I was literally 21 or 22 or something, and we're netting like 40% or something absolutely disgusting. That was our net. Like we were
I believe
complete
it. Yeah,
morons. We did everything incorrectly. I'm just trying to think of hilarious things we did. And we were just afraid to spend on Facebook because our CAC was $10 or $5. And I was like,
yeah,
well, in hindsight, I should have scaled that. But
yeah.
what else
Um,
do you want to talk about here? What else is on the docket?
um, we can talk a little bit about maybe just like the state of like I have some good numbers on this like venture deals in the category.
What
Um,
about joining cults, though? I want to talk about cults for a bit.
well, that's
You cool?
yeah, that's up next, isn't it?
Yeah, it's the Operators Pact. And, I don't need blood. I don't need you to like give me any sort of blood. No blood pacts yet. But I do need you to uphold the Operators Pact. I do need you to go to YouTube and smash that subscribe button. You all get a lot of value out of this. Each episode's better than a $20 book, I hope. So head over to YouTube, smash that subscribe button. That's all we need out of you. That's the Operators Pact. So you want to talk about venture capital?
Um, yeah, I do. I think it's it's post Q1. I think it's timely just to take a quick state of the union, not even just like venture capital, but sort of overall minority equity capital markets in the industry. Um, I have an intern that scrubs the internet for basically every deal that we can possibly find, and so I had her put together some data for me, and
Oh,
I was
you're
pretty
serious? You're not
interested.
joking?
No, I'm dead serious.
Oh,
It's
oh, weird. Okay.
why is that weird?
I just funny. It's just like a funny thing to do. Okay.
Well,
It's
you
like
get a
very
lot of
Drew. I can't think of anything more Drew.
well, it's really easy if you just set up like Google alerts basically and like Edgar, and you just like basically see the Form Ds kind of roll in.
My
So
takeaway is you can take the Drew out of the equity analyst position, but you can never take the equity analyst out of Drew.
no, you can't.
Yeah,
I'm too autistic. I love it too much.
perfect.
Um, so well, here maybe before I dive into this, give me your sense for where you feel the market kind of stands today, from a minority equity perspective. We talked a lot about sort of M&A on this podcast, but we haven't talked too much about call it like seed through B type stuff.
Yeah, I think generally it's still much, much, much colder than what you saw in 2021, 2022. It kind of resembles more of a 2018, 2019 type situation, but much colder. And I don't think you're going to get like crazy VC type valuations that you used to see that are multiples of revenue. I think that's cooled a lot. People are underwriting to much smaller exits. I think we mentioned it before, but exits to kind of like 200, $400 million range. This is outside of food and bev, by the way. I'm not 100% sure on food and bev, but that's kind of where that's sitting for something like hard goods, soft goods, apparel, et cetera. So um, that's what we're seeing. And we're not really seeing what we used to see a lot of was a distressed company would come to us. They'd try to raise at a pretty aggressive valuation. We'd say, look, the math just doesn't work for us. And they might actually find a growth equity investor somewhere. We're not seeing that happen anymore. We haven't really seen that happen over the last 12 months where a deal that doesn't look great is getting financing from somewhere, and we're confused how it happened or what their underwriting process was. And I think a lot of that capital has just dried up and moved out, or they've lost too much money in the category and moved out.
Yeah, I largely agree with the sentiment. I pulled some numbers that I thought went a little bit against my intuition for sort of like the year over year numbers. What's your sort of guess on year over year activity in these markets,
Excluding F&B or including F&B?
including FMB? FMB is an important part of our ecosystem.
I wouldn't be surprised if it was up like 10-15% then year over year, just because I think it's going to decline from where we are now, to be clear, like March on, basically, due to all the Fondue tariffs. But yeah, I wouldn't be surprised if it was 10 or 15%. What was it?
So it's way lower in 25 than 24.
Oh, really?
So yeah, so I basically, the way that I'm looking at this, from both a deal count perspective as well as a deal value perspective. So I've done it by week here, and there's only been 1 week, which was the 6th week of the year, so middle of February, where there was more deals that were announced with more money than 2024.
Wow.
And so I think this surprised me a little bit, and I think maybe maybe I'm just like sort of fixated on like the giant M&A deals that keep happening, but what appears to be happening is that minority equity deals are down year over year, and I think when you step back to consider it, it actually does make a lot of sense, because I personally know so many investors that either used to do CPG/ecom and like literally just don't even touch it now. And if they do, they're doing
It's something
smaller checks.
adjacent, right?
Yeah, like like a lot of
Like
those guys have
infrastructure.
moved. Exactly, they moved over to like
Yeah.
sort of an enablement infrastructure or whatever, like business models that really should and like do support sort of venture capital a little bit better. Um, and
Well, let's
then
let's drill down on that. Like, what do you mean by that? What supports VC dollars better?
yeah, so basically just like the sheer magnitude of the outcome. So like you said, 2 to 400 million, which I think is right. I would maybe open up that range a little bit and just say 2 to 500 million, just to nickel and dime you on it. But essentially, like these companies, if you're doing, let's just say like 10 or 20 million dollars in top line as like a CPG brand, you would raise at, let's just say like 50 million, 2x your trailing revenue if you had like 25 million or something. You have to become a 10x from there, really to sort of satisfy the investor's business model of like returning their whole fund off of one bet.
And again, you have to do that, like, assuming you don't raise any more capital. Because if you raise more capital, there's going to be dilution that's incurred for them. So you have to keep that in mind too. And that like increases the roof so much more for where the outcome needs to be, or the floor.
Yeah,
Sorry.
and to be clear, like 10x is probably like pretty low for like a true like venture capitalist, right? Like it's sort of like the power law, spray and pray. Like one of these is 100x, the rest of them are dogs or just a couple x kind of a thing. So basically, in 2021, I've written a lot about this. I think it's a fairly fascinating topic, specifically with like DTC, where like the Dollar Shave Clubs and the Warby Parkers and like all that, like when you reduce them down to like just their financials, a really good looking D2C brand actually does look a lot like a software company from like a financial mechanics perspective, from the standpoint of like, they have really high margins, they have recurring revenue if it's on subscription. Like there's generally, like I said before, like when we're talking about hymns, right? Like it's like the balance sheet is generally okay. Like there's inventory, but it's not, if it's orchestrated properly, it can be totally fine. And so all those investors, just when there was so much money that flooded into like these funds, like in 2021, like I was, raising, I think Mad Rabbit's Series A was in 2022. And like every Yahoo with 30 million bucks is somehow like managing like the next like venture fund. And
And you would see things like founders that had venture funds on the side, which was really
yeah.
like part-time venture funds. And I was just wondering who's investing in these, because we do invest in other funds, just so I learn more
Oh, you
about the
do.
category in general. Yeah, and not like a huge check, but like 100 grand, 500,000 here and there, or whatever.
Mhm.
But like, I was getting pitches and I was looking at some of these funds, because we always invest in emerging managers. Like it's just too small for me to personally, or we're too small to personally invest in like some well-known fund, right? Because the minimum buy-in
Mhm.
would be like $5-10 million. So, But I was looking at the pitches and they made no sense. It was like, yeah, I'm just doing this part-time, 10 hours a week. And I was like, why? Who's writing a check? It's terrifying. Like part-time, 10 hours a week. Like it's still like 20, $30 million they're trying to raise, or 50 million. I don't know. I'm not doing that.
But so those managers like were at the back of the line for like deal flow, basically. And so what they would do is they would I don't know that they were wrong at the time, because sometimes these things did look nice. They were, and I'm talking a little bit more about like 2018, maybe 2017 kind of a time. Like, these managers, they're not getting into like the hot software deal, but that like hot DTC deal like kind of looks just like it. And Dollar Shave Club just sold for $1 billion. So like, I can get behind this. And then obviously that like vintage from, probably after 2015 at this point, maybe like 2018, like all these vintages have just like returned like absolute crap. And so people are just still pretty beat up on the category. Like even like when I talk to investors about Iris, like I get decent flack just for like having these brands like be like customers,
Really? It's that bad?
Like
so I do feel like the main thing the VC firms discovered is that there's not nearly as much operating leverage and like margin expansion that comes with scale in direct to consumer, right? Like, we're selling physical products where the cost of goods can only drop to a specific amount. And I think a lot of them underwrote CAC staying consistent or dropping as well, which obviously doesn't happen with scale, or you rarely see it. I mean, you see it sometimes, it's very rare. And obviously when you're raising money, it just means you have to keep being really, really efficient with deploying that cash. And it's hard to do if you're growing really fast. So obviously your COGS just can't get to zero. They'll go down a little bit. They're not going to go down to zero. And you get a much better dynamic with margin expansion when you're running software business versus consumer. So I think that's kind of the main thing. That kind of goes back to
the where are you going to look for cuts, right? It's like OpEx. Like there's so much, like so little operating leverage in these CPG models that like there's not that many fixed expenses. There isn't. So that's great in times of distress because you can shrink your cost base very rapidly. But when it's going well too, you have less margin expansion on the back of that. So like, as somebody who is now running a software business, like we're actually with Iris very close to profitable. We're probably 20 customers away from being profitable. And then every customer that you add on after that, like our gross margins are like 92% or something. And so like, it's
you guys heard that here first. Now you know how much of a discount task force come through.
Oh shit, I shouldn't have said that. We should cut that. But basically, every customer that you add after that is just pure profit. And so it's really, well, not pure profit, but pretty close to it. And so it's a model that scales very, very nicely. And venture capitalists are just, it's easier to underwrite like large outcomes. So I'm not, I feel like anecdotally, I probably would have guessed that 2025 is doing better than 2024 sort of in the minority markets, but right now it's not what the data is telling me. And I definitely don't.
I'm assuming most deals coming up are paused until people can figure out how to underwrite the tariffs, right? I mean,
well, that's like the other thing that I was going to ask you about, right? Is like the public market now has taken an absolute dive. So like let's give our listeners like, what do you think? How do you think that sort of impacts this already fairly low activity, right? I mean, it's looks pretty bad.
Yeah, I think if you're a minority equity investor, typically you can be cool with adjustments to EBITDA or whatever you want to argue there. It's just hard to argue which way things are going to go currently, right? Do you burden COGS going backwards when you underwrite a deal? Or do you pretend like, hey, this is all going to go away in 60 days? And it's just tough to know what's going to happen, which way for now. And there's mechanisms to get around that, right? Like I can say, hey, if I was doing let's just say I'm making a control investment, so I'm buying a company outright, I can say, hey, if X happens with these tariffs, like let's say they stick around, I'm just going to pull that out of the earnout that I owe you. But you might not be okay with that, right? Like you might really believe they're going to go away and you'd rather just hold on to the brand. That might kill the deal. I have a friend right now who's in the middle of selling a business that I think is doing $50 to $80 million a year. And it's more or less on hold because one of their product lines specifically comes from either Canada or Mexico. I can't remember. So it comes from there. And because of that, the deal can't go through until they've decided how to deal with the issue. And just on pause because of that for the last, I think, 2 months, month or so.
Yeah, and like it kind of sucks because like I've been very loud about how bullish I am sort of for M&A specifically, and I don't want to take that back yet, but I do think that, I mean, clearly clearly it wasn't priced in to the public markets, and so I think that you're just, yeah, I mean, generally speaking, like, these investors are probably going to be pretty slow at slow at best, really.
Totally.
Slow at best and frozen probably at worst, which is a bummer because things are still going pretty well in this in the M&A space, and so it would be a real shame to kind of see that tick down because of these tariffs.
Totally. And you want to know what I've been thinking about a lot more over the last few years,
What's that?
especially when it comes to making vendor decisions? The rate of improvement that the underlying software makes, if I'm picking software, or even just a vendor in general. It sounds silly, but
Mhm.
let's use our sponsor Fulfil as an example. I looked at them the first time, I think 1.5, more than that, 2 to 3 years ago before we actually implemented it. At the time, I thought it was really cool. I was like, this is a nice to have, but it's not a must have. I can't justify it. Then Sharon slid into my DMs. He showed me some of the new features they had. And I was like, we actually need this. We'll save a ton of money, probably within a quarter or two. It totally worked out really well. They helped us with the implementation, extremely smooth, even though we're a relatively small customer for them compared to who else is on the platform. Like I think Ridge is on there. They've added even more features, and I actually get excited whenever I receive an email that shows what they've added. It just sounds really nerdy and horrible, but there's cool stuff that they add all the time, and I'm like, wow, that's nice to see. Versus something like, I'm not going to name them, but the old school ERPs from the '90s, from when we were born. You're not getting updates like that. And if you're getting an update, that's cool. It's going to be through some sort of weird third-party integration partner who's built their own little bolt-on thing for it, and it's not going to work properly. It's going to break during your peak season, and you're going to be really pissed off. So if you want an ERP that works, that's built for modern-day consumer, I would definitely hit up Fulfil. Let them know that the finance operator sent you. Head over to fulfil.io and check it out.
Some of
All right.
our best run brands are on Fulfil. So
Oh,
I,
really?
I
Cool.
continue to see it more and more, and I mean it's clearly a best in class tool. Um, every time there's like a really great brand that I meet, and I'm like, oh, like what's your tech stack, and then like they're like Fulfill, and I'm like, okay, well that checks out.
There you go. Yeah. Cool. So there you go. You'll get the blessings of Drew if you do it. So uh, what else? Anything else on the VC side, minority equity side that you want to discuss?
um, I want to maybe just really quickly. So since we've kind of set the stage on sort of the overall activity and maybe a little bit of the hesitations that we expect to see from the market, I really quickly want to help everybody level set valuation expectations. So if you are going to raise money, and I'll be curious your take on this. Well, actually, why don't I just ask you right away? I am a brand. I'm growing from 10 to $20 million. How much am I raising, and like what's a reasonable valuation? Obviously, there's a lot that goes into that, but like just give
It
me like a
is.
ballpark.
It is all over the map right now. I feel like let's say you're not. Let's say you're doing hard goods and you're not doing something like beauty, not doing something like apparel. I would say you're probably aiming to raise something like 2 to 5 million, and then looking to use debt to really scale. I feel like people have become much more disciplined and better about utilizing credit versus just pure equity, and they've kind of realized, hey, I don't necessarily need this much equity. I can't justify this much burn. There needs to be a really clear case for how this is going to make you more profitable, or how this is going to improve the business versus just we need it to scale and we'll
Mhm.
make up for it on the LTV side. I feel like you get away with that before, say during
That
COVID or
was
something, where you could say,
yeah.
yeah,
And what's my
like you'll get a
valuation then
pitch.
if I'm raising 2 to 5 million? Like what's like a reasonable valuation I can expect to fetch?
Pre tariff or post? Because I think pre. Um, and it depends on the brand what the unit economics look like. But honestly, I'd be shocked if you're getting anything above kind of 10, 20 million. I'd say it's
Okay,
pretty good.
so 100% growth, and you're only going to give
Yep.
me 1x my sales.
Yeah, and I think that's pretty generous,
Okay.
especially right now.
I might be a little bit loftier than that. I would say that if you were growing from 10 to 20 million and you got
Mhm.
like a 30 or $40 million valuation, you should feel pretty good about it.
That'd
Um,
be great. I'd be literally gleeful. I will sell, if anyone's listening, I will sell any of my positions at that valuation. Some of them are pretty growthy, but I'm happy to empty my pockets.
If somebody came to me and they had triple digit growth, depending on the category, I would tell them probably to raise it 2x sales, just to try to get a little bit of credit into 2025. But that's down from 4, 5, 6, 7x sales for some of those 2021
Who would you actually
deals.
go to raise right now? Like, who are the first 5 firms that you would hit up right now? Just email. For pure play growth equity, like let's say I'm in a hot category, I'm like in beauty or something where it's easier to raise, not hard goods, like beauty, maybe apparel.
I've got a lot of friends on the investor side. So like, like if I was raising growth equity, I'm a big fan of the team over at Carp Riley. They have big positions in like Mack Weldon. There's a fund called Anthos that I'm close with Scott Norton, who is the one of the founders of Sir Kensington's. He now sort of works in a role there. You've got like Summit Partners, obviously, that we've touched on a little bit. You have like VMG.
Will Summit touch a deal that small though? Don't they want closer to like, I'd say 50, 100 million in revenue?
If I don't consider 2 or 5 million to be like a growth equity round. Like that's like
no, it's kind of small.
Yeah. So so like more like venture-y. Like Listen
Sorry,
Ventures is a group here in Chicago. I know like Selva Ventures does that kind of stuff. Even like Amberstone will kind of dip that low. I posted once. I posted like an equity market map. Well, here, why don't I can just kind of pull that up.
Zoom and enhance. Oh.
Because I think it's an interesting thing that like people should know about. So like Barrel Ventures, actually Nate Cooper is an investor in Iris. He's actually my largest investor.
They do a lot of F&B, right? I think
they do a lot of F&B. Yeah.
Okay. Yeah. So let's exclude F&B. Let's exclude F&B because it's kind of weird.
Okay. True Beauty Ventures. They're doing a lot of the beauty stuff. Yeti Capital. You ever run into Yeti Capital? Those guys are kind of like seed stage consumer. It's actually the Yeti family office situation.
Oh, weird. Okay.
BAM. BAM. Everybody knows BAM. They're in LA. They were like pretty famous for being like the Honey deal. They did like one of the first checks into Honey, which obviously was a huge exit. Belliad in New York too. They just invested in one of our customers called Nima. Which is like a women's care brand. Boulder Food Group too. They've actually been on a decent tear with like the Olipop deal, and then
cool.
I think they're in 1 or 2 other ones that's kind of gone over recently. And then Palm Tree Crew is another one too. So they're like Kygo's fund. Those guys are pretty active. So yeah, I mean there's no shortage, honestly. There is a shortage actually compared to what it used to be, but there's still a lot of those players. And I think they're more focused on what you said, which is like, how does this money like clearly make the business stronger and more profitable? So yeah, there's Maveron's another one too. Shout out Jerry. Jerry's a friend of the pod.
Yeah, they're like I think we talked about them before, but that was co-founded by the Starbucks guy Howard Schultz or something.
Yeah, and they like famously are like still holding their Allbirds position. So I've become friends with. Yeah, they're on the board. I think they did quite well on the investment. But they still are like a big shareholder, and I've become friends with one of their partners there named Jerry. So I know that he'll listen to this. So shout out Jerry. Yeah, I mean, overall,
the first ever person I talked to from VC was from Maveron.
Oh, really? Have you ever raised venture capital?
We have we've only sold in rounds. Like a VC will come in and we'll be a seller.
Got it. That's probably worked out.
Yeah, it's worked out really well. Yeah, like it was a good time to sell secondary, and I wasn't really aligned with the valuations. And by what I mean aligned is like I thought they were pretty generous. I'm like, you know what? I'll do whatever you want. I'll sell. If you're struggling with your unit economics, you don't really know what's going on, you don't feel great about the financial visibility that you have, you can use a tool like Iris, and that's what Drew works on all day. Day in, day out, you'll have Drew working for you, sweating. You can call him at 2 a.m. and complain. It's okay. I'll give you his phone number. message me on Twitter, whatever you want. I'll send that phone number over so you can complain to him if there's ever anything wrong. But yeah, I think a tool like that can be really powerful. It can give you financial insights that you might need like a financial analyst for, especially if you're not super savvy on the finance side. So one of the things we're working on right now is a roll up of a handful of men's jewelry brands. Well, they don't have to be men's focused. We'll do women's too. And do you think we should start by explaining the concept behind a roll up?
Yeah. Tell me what a roll-up is.
More or less, a company's sold. If you actually go to sell a company and you're not in a super, super hot category, it'll be sold based on your kind of trailing 12-month EBITDA and your growth, et cetera, quality of revenues, blah, blah, blah. So let's just say EBITDA is the main determinant of what your value is. You get assigned a multiple, and that multiple goes up or it expands. It's called multiple expansion as the company gets bigger and as that EBITDA number becomes bigger. So 2 million, you might say get, I don't know, 4 to 6x on kind of your average brand. And as you go up, let's say 4 or 5 million in EBITDA, that might go into say 7 to 10x, depending on how hot the space is or whatever. So the thesis is pretty simple. You acquire brands and you pay, they have a lower EBITDA multiple essentially than the platform, which is all of them put together. And people call it arbitrage because there's no risk, but there is definitely risk. And I don't like to call it arbitrage because I think it's kind of a stupid thing finance guys say, where they just think it's like, oh, it's totally risk free. We'll just integrate them into our current stack. It's like, I don't know if that's going to work so smoothly, but
Is that what
luck.
they sound like?
Yeah, they have that silly voice too. I nailed it perfectly. They sound like a cartoon character. So yeah, I mean, the goal is to buy a handful of jewelry companies, hopefully with differentiated audiences and slightly different customers.
How much are you willing to invest in buying these companies? And what do you think is the outcome?
We have a very cool edge which I will not talk about, but you'll get like a 7 or 8 figure check up front. And then there's much more on the backside for you. And the way that works is, let's say your company has 2 million EBITDA. Let's say you think it's worth 7x. We give you 7x, but you now have some equity if you decide to roll into the platform. And then when we go to sell the platform, you'll get a multiple of whatever that platform's EBITDA is. So there's quite a bit of comp on the back end for someone as well, not just the first bite of the apple.
What's like the sort of, can you speak to like the overarching thesis around like why jewelry, why now? Like what's so interesting about it?
My co-founder actually used to be the CEO of ice.com, which they sold the domain to some stock exchange. I can't remember who it is, but at the time that was the oldest online jeweler. So we actually have a fair bit of experience in the vertical, and we've done a handful of jewelry deals before. We have one brand in our portfolio right now. We're looking at closing on a second. So, and for some reason, we know a weird amount of jewelry brand owners. So we're in discussions with a few of those to see what we can do. I think it'll be really exciting. I like a lot of the dynamics in jewelry. Obviously, margins really, really good. TAM's exceptionally large, especially women's jewelry, but even more niche jewelry, right? The guys at Ridge have done a really good job of building a brand for their rings, for example. So, yeah, I think the thesis is our deal flow is pretty good. We feel pretty good about execution on the kind of organic growth side, just given our experience in the space. So if you have a jewelry brand, hit me up.
Who do you think's
I want to buy it.
who do you think's the buyer of the platform?
Yeah, there's quite a few strategics, and they're fairly acquisitive. Like you'll see it happen quite often. Your other options to sell upstream to more of a middle market private equity fund, which I don't love the idea of. And then the third option is just realizing liquidity through something like a recap. Obviously, something that has closer to 20 to 30 million in EBITDA is much easier to lever up and issue a dividend on versus something that's
let's unpack that. Let's unpack that really quickly. You said realizing liquidity through a recap.
Sorry, it's a bad sentence.
No,
I've been talking to too many bankers.
No, it's a fine sentence. But I actually am a pretty big fan of this whole strategy, honestly, for lots of our customers, because I think it's a nice way to hold on to your equity and still make money. So why don't you give us a quick sort of rundown on what you mean by that?
Sure. So everyone's familiar with the concept of a mortgage. You borrow money, you buy a house. Everyone's also familiar with the concept of remortgaging your house. If you want to do, let's say you've paid off your house, you built up a lot of equity in it, and you decide you want to remodel the kitchen because that's what seems to happen every 6 years with everyone I know. And now they want to you want to refinance the house, kind of get more debt out against against the house and use that to execute the reno. It's the same case here. You can do that, except it's not personally guaranteed if your company is large enough. So if you're doing something like 10 million ish in EBITDA, maybe 5 million, depends on how the credit markets look and what their appetite is. But you can usually argue for kind of swapping some credit in for financing kind of ongoing working capital needs, and then use that cash that you create to pay yourself. And again, there needs to be a pretty good argument for it. They don't want you to take out so much that you'll just run off. But it is a nice way, like you said, you still hold the company, you still have all the equity that you had before. Now you have a lender on board. And I'm not saying you need to go out and, get like 6x on trailing 12-month EBITDA or something. And no one's going to give you that. But you could go out and get 1 to 2x, and that's often enough, right? Like, what are you going to do with $5 million or $10 million that you can't? Sorry, what are you going to do with like $50 million that you can't do with 10 million? I actually don't know, unless you're a total psychopath and you need to buy a jet or something. I think you're totally fine with $5 or $10 million, and you'll still hold your company.
Speak a little bit about why they call it like a recapitalization.
Mm-hmm.
Like from like a balance sheet perspective. I think it's like kind of interesting.
Most of the time, a company is running with some level of debt. If you're really, really impressive and super lean, maybe you're running with no debt at all, and it's just a phrase. I honestly, you see it used really liberally, even when there is some equity being purchased, recapitalizations in general. So the real kind of way of thinking about it is you're kind of filling the debt up that the company can store again, and you're using it to pay yourself out. And in a private equity transaction, typically, not most anymore, but like let's say 30 to 40% of the deal might be funded with debt, and that'll get paid off over time. And that deleveraging as the company organically grows is what creates returns. So in this case, you're like buying the company from yourself basically and acting as a private equity firm, if that makes sense. But
and you kind of just like drain like the retained earnings basically, and then you put the debt.
Exactly.
You increase debt, you like decrease equity effectively on the balance sheet, and that's like why it's like recapitalizing, because you're sort of redoing the capital stack.
Which I think at the core, like the easiest way to think about it is you're just refinancing your house. That's all you're doing. Yeah.
It's not something that enough people do, I don't think. I mean, it's like there's risk involved to it, but like, if you're running a business that's doing 100 million in sales and you're decently profitable, like, and you're not really growing that much, you're not going to sell it for a price that you're going to be very excited about. And so, it's worth sort of like exploring monetization strategies sort of outside. Like I think maybe we should do like another episode on this, is just like monetization strategies like for your equity, where like obviously like you can pay dividends, you can sell secondary, you can do, recaps, you can sell your business. Like there's so many different things that you can do. And I feel like oftentimes founders, they sometimes just think like, oh, like I either like sell my business or like I just do nothing. And it's like, well, no, I mean, there's a lot of different things.
I've seen 2 or 3 horrible deals where my friends sold equity. And I told them this is horrible. This is really stupid. But they sold equity to a private equity firm, a non-control stake. Then the firm levered the company and effectively paid themselves back right away. And they had all these other protections on their capital. So it was like, guys, you didn't need the private equity firm. You could have gone out and literally done this with any semi-competent CFO, or even just hired an investment bank to advise you through it and done a recap yourself. Like, it's kind of pointless bringing the PE firm in. Anyways, and they don't add any value. Like a lot of these PE firms are not going to jump in, and these ones specifically because they're buying so little on the equity side, non-control, et cetera. It was really silly. So, you know who you are if you did that. I sent a few of them a text. I said, bad. So.